Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The pressure cooker market, macro threads and micro moves. This video presents a direct informational narration of the source document. We'll be breaking down the macroeconomic factors currently squeezing the stock market and exploring exactly how institutional capital is reacting to these conditions. Today's agenda covers 5 main sections. We'll start with the market's waiting game, move on to geopolitics and trade wars, look at the bond yield threat, do an AI chip reality check, and finally, follow the smart money. Section 1. The market's waiting game. Right now, the market is experiencing a period of calm before the storm. Tech and semiconductors are specifically feeling the drag as investors pull back their capital to wait for greater clarity. Market participants are essentially holding their breath for this week's super catalysts. Wednesday brings critical data, including NVIDIA's earnings and fresh PCE inflation numbers. Then on Friday, focus shifts to a crucial speech on interest rates by Federal Reserve Chair Jerome Powell at Jackson Hole. Section 2. Geopolitics and trade wars. While the market waits for those catalysts, geopolitical threats are putting increasing pressure on global supply chains and inflation expectations. The U.S. Treasury announced a global economic blockade on Iran, targeting specific sectors: digital assets, technology, aviation, and shipping. The source document notes that this raises immediate concerns about stability in the Strait of Hormuz, which could lead to a sudden spike in global oil prices. Concurrently, North American trade negotiations have broken down, triggering a series of reciprocal tariffs. The U.S. placed a 50% tariff on $20 billion worth of Canadian goods. Canada responded with a retaliatory 50% tariff on $20 billion of U.S. goods, taking effect on September 8th. Looking ahead, there is also a proposed 50% U.S. tariff on Canadian autos, slated for January 2027. Section 3. The bond yield threat. All of this inflation and geopolitical pressure feeds directly into the primary weight currently suppressing the stock market: rising bond yields. Yields did dip slightly on reports that the U.S. Treasury might use the Treasury General Account, which is a roughly $950 billion asset pool, to fund long-term bond buybacks. However, the fundamental supply and demand issues driving rates toward 5% still remain firmly in place. This data juxtaposition illustrates an important point. S&P 500 forward earnings growth is at 24.9%, which completely outpaces the index's price growth of 12.1%. The source indicates the market isn't dropping because valuations are too expensive, but rather because high Treasury yields are crushing tech valuations. In response to these physical concerns, capital is fleeing to non-sovereign safe haven assets. Gold jumped over 6% in just 4 days, while Bitcoin surged approximately 23% in a single week alongside massive ETF inflows. Section 4. AI chip reality check. Next, we examine how this macroeconomic pressure is squeezing specific sectors, particularly artificial intelligence. NVIDIA has notified customers that their Blackwell and Grace AI server systems will see price increases exceeding 15% early next year. This tests the assumption of whether the massive capital expenditure cycle in AI infrastructure can actually be sustained by corporate buyers. Pricing pressure is also hitting memory chips. Rumors suggest the U.S. government might allow Apple to source components from Chinese manufacturers, triggering a sharp, sentiment-driven sell-off in major U.S. suppliers like Micron. However, the source document notes that these supply chain rumors are heavily driven by short seller sentiment rather than immediate fundamental realities. Chinese manufacturers still face significant yield and certification limits, making this a sentiment-driven reaction. Section 5. Following the smart money. In this volatile, sentiment-driven environment, the document outlines how major players and corporate executives are actively positioning their capital. Recent disclosures show options and stock trades made by Nancy Pelosi have an estimated upper value of $13.5 million. This includes heavy bets on Intel and major semiconductor stocks. What is notable about this data point is the timing. These positions were entered between July 24th and 28th. On July 29th, the semiconductor market hit its absolute bottom before a violent upward rebound. On the corporate side, Alibaba announced a massive $10.2 billion secondary stock offering in Hong Kong to fund their AI infrastructure. This makes it the third largest equity offering globally this year. While Alibaba's core executives purchased approximately 1.2 million shares to help stabilize market sentiment amid the massive offering, notable short sellers remain highly skeptical. They argue the stock is overvalued and that the equity financing will simply dilute shareholder returns. The document leaves us with a final question regarding this market environment: whether market participants are playing the short-term volatility game or holding strong on long-term industry logic.